Maverick Traders. Nice to see you here. This is Rob, and we are going to jump into futures. All right. Futures trading, we're going to jump into it. We're going to break it all down. We're going to talk about how it all works. But the one thing I really want to get into everyone's head is that futures trading, where it seems like this exotic, strange thing, it's very simple. It's very simple. Trading is not simple, but understanding how the futures work, pretty simple. All right, let's get into what is a futures contract. And this is how it all started. Futures contracts have been around for hundreds of years. Now, futures exchanges have only been around for about, I think, 120 years. About 120 years is when the first futures exchange was created. But people have been doing futures forever. And it really started in agriculture. Now, let's take this scenario where we have a farmer that's growing corn, and we've got Kellogg's who makes cornflakes. Now, each one of these groups of people have some needs. Now, obviously, the farmer's trying to make as much money as they can on their crops to be able to provide for their family and able to grow their business and to reinvest in next year's crops. So the farmer's taking a look at his records and books and says, okay, you know what? I need to be at $4 per bushel. That's my cost for me to grow this bushel for a season. Now, of course, all this hard work starts in March and April, and tilling the soil, buying the seed, planting the seed, water, irrigation, all that stuff. So the farmer knows, okay, it's going to cost me about $4 per bushel. Now, here's the problem: is that the farmer is going to go through all this work and put up all this risk. And when harvest comes in October, he has no idea where the price is going to be. Now, if the price is $3 per bushel, that's going to be pretty devastating to the farmer. He's going to work that whole year and actually turn in a loss. So the farmer definitely wants to be able to lock in a price above $4. And if they can lock in a price above $4, they know that they made a profit that year and that they're going to be in business next year. Let's take Kellogg's on the other side. Kellogg's needs to buy corn. They need to buy corn, and they need to know, okay, what is our cost of corn? Now, right now there's a market price, but they're a little bit worried that prices may go up because they know that they have to pay less than a certain amount. And let's just use $5 here. Kellogg's must pay less than $5 per bushel to ensure that they're profitable for the year. And again, they don't know what the cost of corn is going to do, but they know that they need to lock in a price of below $5 per bushel. So these two parties enter into a futures contract. All right, so this is a futures contract. They agreed that they're going to enter a futures contract for the price of $4.50, where the corn is delivered in October. All right, so that's how it works. That's how it works. This is a contract. So you can see that it works out well for the farmer. The farmer is now locked in a profit for the year. It works out great for Kellogg's. They've locked in a price. Now, when they enter into this contract, each one of the parties must put up some money, each side. So again, the farmer has to put up a little bit of money to let Kellogg's know that they're serious and that they're going to perform. And Kellogg's has to put up a little bit of money to show the other party, okay, you know what? We are definitely going to be buyers at the end of this. Here's some money as a deposit. Now, this deposit works just like an escrow deposit on a house. Earnest money. When you put earnest money down on a house, you're saying, hey, look, I want to buy your house. I'm going to give you this money today that is proof that I'm going to follow through with what I want to do. And again, hopefully everyone knows how that works. So this is a futures contract. And this is how the futures contract started. And as I said, this has likely been going on. We don't know for how long. Well, you can only go back to so long in recorded history. But my guess is that people have been doing futures contracts since the beginning of time. Since someone made a farm and since someone had a lot of food that they needed to sell, they figured out a way to write a futures contract. So this is basically how it works. You've got two sides. You've got the buyer and you've got the seller. And each side puts up they agree upon a price, and then each side puts up a margin deposit. So again, don't overthink it. That's just what a futures contract is. Now we're going to get into the depths of the futures contracts, how they work, what they control, all the terminology, all the margin. We're going to even go into something called contango. We're going to get into it. But this is where I want to start out. I've always said this, and I know it doesn't make any sense, but many of you have probably already heard me say this. Trading is trading. Trading is trading. Everything you trade is simply a symbol and a current market price that will move up and down based on supply and demand. Now, this is where I always think people get themselves in trouble. And this is where I cannot stand the way that Wall Street has gone, where it's better than it used to be. When I started out trading, it used to be no one can make money as a trader. The only way to make money is to invest and to buy and hold for the long term. That's where I started, and people looked at traders and said, hey, that's a joke. Now we have shows like Fast Money. We have people on there telling you, hey, you want to trade this. It's awesome, but here's what I see the problem. They're still in this buy and hold mentality. And I hear stuff like, oh, you know what? I'm trading this stock because it's a good company, it's got good fundamentals, and I like what the CEO is doing. Oh my gosh, that drives me absolutely insane. That's not trading. That's still investing. Trading, you should not care what the underlying symbol is. Look, if the symbol is AAPL, I don't care what it does. I've had people ask me, what are you trading right now? And I'll be like, oh, okay, the symbol is JNA. And they're like, okay, well, what does it do? I'm like, I don't really know. You don't know what the company is? I don't even know what the company name is. Because it doesn't matter as a trader. As a trader, the only thing that should matter to you is where the market price is going. And the reason it drives me crazy is because people get themselves in trouble mixing this buy and hold mentality where they talk about fundamentals and where they use their fundamentals to justify their poor decisions in trading. When a stock goes against you, when a trade goes against you, you better have a plan, you better have an exit point, you better have risk management. It doesn't matter if the CEO is a good guy. It doesn't matter if the company is growing earnings. That has nothing to do with trading. Okay, wow, that was a rant and rave. Perfect. Let's come back to futures trading. So basically, in the end, if you can trade one profitably, you can trade them all. Now, this is just a matter of speed. And I always give people the example of, most people start out equity trading. Now, if someone were to start out equity trading and they started out in trading stocks like IBM, like General Electric, General Motors, those are slow-moving vehicles. And they move around, 1, 2, 3, 4% in a month. Okay. There are faster vehicles. We could take a look at stuff like Tesla stock. We could take a look at stuff like Amazon and Netflix. Now, those are still stocks. They're still the same thing, but they just have more volatility. Again, we can then get into Forex, foreign exchange, which is a faster car. It's just more volatility. But in the end, it's a symbol and a current market price. So technically speaking, if you can trade one profitably, you can trade them all. You just need to learn the terminology. That's it. So let's break all that terminology down on futures contracts. Because futures contracts have 4 things. First of all, it has the underlying asset, how much of the underlying asset, the delivery location, and the delivery date. All right, now let's first of all talk about delivery location, so we can just cross that one out. There are old stories, and these are probably wives' tales, not true. But I remember hearing one story of an oil trader who forgot to close out his contracts in the 80s, and a couple months later, he was delivered, $100 or like $1 million of oil to his house. Now that's ridiculous. Maybe it's not 1,000,000 barrels, but anyway, um, I've heard that story before, and I'm like, okay, that probably never happened. But the delivery location, it is in the contract. It is in the contract. Now, the way it works now, when you trade these through a brokerage or broker dealer, um, there is no delivery to worry about. You physically cannot get delivery at this point. You have to have a very special account with special instructions to actually get delivery. So if any of you are a little bit worried about, 1,000 bushels of corn showing up on your doorstep, you don't need to worry about that. So delivery location, it's in the contract, but it's nothing to worry about. So let's really talk about underlying asset, quantity of the asset, and the delivery date. Now these are the three things that we definitely do need to worry about. So let's take the COMEX gold futures symbol. So again, as I said, everything is a symbol. So the symbol for the December 2018 COMEX gold futures is the GCZ18. Now let's break it down. GC is the root symbol. So it's just like the old school option symbols. You had the root, which signified the underlying stock, and then you had the month and the year of expiration. So if you wanted to take a look at what this what this future was doing, you would simply look at the GCZ18. And again, you can chart it. It looks just the same as a stock on a chart. It trades just the same. Remember, a stock chart is simply a visual picture of supply and demand. That's all you're looking at. All right, the contract size of the GC is 100 ounces of gold. All right, so 100 ounces of gold. Now, all futures have what are called ticks. Now, ticks are very similar to what we do in Forex called pips, whereas stocks always trade in dollars and cents. So in stocks, we don't really need to talk about it because, okay, we know that a $50 stock, $50.01 would go up to $50.02, $50.03. That's just how stocks work. Well, futures all work a little bit differently. We talk about, again, and you who trade Forex with us, we know a pip is 100 thousandths. No, that's a 10,000. So a pip is 0.0001. So Forex trades in pips. So again, it's this 10 thousandths of a cent. This is simply a tick where the gold futures will trade 10 cents. What that means is that if gold is at $1,200.10, the next move will either be $1,200.20 or $1,200.00. This is the smallest increment it can move. It moves in ticks of 10 cents. Now again, each contract will have different ticks. With Google now, it's pretty easy if you ask yourself, geez, I don't know what the minimum tick size is for the corn futures. Well, just Google it. Just Google it. It'll tell you within probably a half second what it is. And again, the value of one tick on one contract. So again, these trading contracts. So one contract, 100 ounces, minimum tick of 0.10, and you are looking at $10 US dollars. So it's pretty easy now to handle your position sizing and your risk management. If you say, okay, well, I don't want to risk any more than $500. Well, now you know that you basically are looking at 50 ticks, or you're looking at $5. So again, you'd be looking at a $5 move, saying, hey, you know what? I will be in this for no more than a $5 loss. That would give me the equivalent of a $500 loss. So it really is fairly simple whenever you look at these symbols. Now, here's what's not easy is contract size. Each one of these are going to have different contract sizes. And even you're going to find different contract sizes in the same asset. So I believe there's another gold futures contract that's a smaller one that controls 10 ounces. Again, this is all stuff that you can go out, figure out on your own. take a look at it. But in the end, this is how it's going to work. You're going to make a trade. And again, let's say you are looking to buy one contract of the GCZ18. Well, one contract size is 100 ounces. The current market price, let's just say, is $1,200. That means that you are controlling $120,000 worth of gold. Now, that's what you really need to know. And this is the thing I really wanted everyone to understand, is that this is how big your trade is. It's $120,000. That's what you're controlling. So if it goes up 1%, pretty easy to do the math, you have made $1,200. If it goes down 1%, you have lost $1,200. This is really what the trade is. I know we just talked about ticks, we just talked about all the other things, but in the end, this is your trade. Again, this would be the equivalent of buying 100 shares of a $1,200 stock or 1,000 shares of a $120 stock. It's the same thing. You are controlling $120,000 worth of gold, and your return is simply going to be your percentage return off that amount. Now remember, in the future example between Kellogg's and the farmer, they had margin requirements. Now again, this is where margin requirements are going to be different at every single broker. Every single broker dealer will fit, or they'll put up their own margin requirements. Some will have what's called intraday margin. Some will just have one margin rate. Again, it gets a little confusing as you go from broker to broker, but here's the great thing. Jump on Google, type in what are the margin interest rates on the gold futures contract at Thinkorswim, and it will tell you what it is. Now, typically, they're going to be about 20 to 30 to 1. That's typically what you're going to find. You can find some brokers that will give you up to 40 to 1. But I always tell everyone, on most futures contracts, you're going to get 20 to 1. Now, obviously, on lower volatile positions, like gold is not very volatile. Gold is not very volatile. So if you can see here, margin requirements for one gold contract IB are above 30 to 1. The things that are more volatile are going to have higher margin requirements. And again, these margin requirements will change as the underlying price of the contract changes. But for the most part, you just have to look, okay, what is it? One of the things I love to do is I build an order in IB for one contract, and then I hit my preview order button. And when I hit the preview order button, the screen pops up and says, okay, this is the margin requirement, and it also will show you the total amount you're trading. It'll actually show you both these numbers. Here's the margin requirement. Here is the total amount traded. And again, if I'm just curious about it, I hit the preview button, it shows me, and then I just cancel it out, and I can see what the margin is very quickly. Now at IB, they have overnight margin. So the futures contracts, they do trade 24 hours a day. Now again, I say 24 hours a day, we'll get into that. But they're always trading. So what is intraday? What is overnight? Well, intraday is going to be from the basically the U.S. session. So the U.S. futures market technically opens at 8 a.m. Central Standard Time and closes at 4. Yeah, it closes at 4 p.m. Central Standard Time. That's what they consider intraday. If you hold that overnight, that margin is going to change. That's just intraday and overnight margin requirements. All right, so let's talk about what we need to trade. Because as I said earlier, trading is trading. What do we need to trade? And this is the question you need to ask on anything. Anything that you want to trade. This is the question. Is there price discovery? Now, what is price discovery if you don't know? Can you quickly find out the exact price that you can sell it at right now or buy it at right now? This is something that people don't really think about. And over the years, this has been something that has really got people in trouble. For any of you that watched our cryptocurrency session we did, we talked about how we don't like buying the actual cryptocurrencies because of price discovery. Price discovery meaning you don't know exactly what the price is because all the different exchanges have different prices. And so it's really hard to know exactly what your Bitcoin is worth or what your Litecoin is worth or any of the others, because what's selling for on one exchange could be selling for something totally different on another exchange. So we need to have price discovery. Whatever it is you're going to trade, you need to have price discovery. Now, my favorite story about price discovery happened back in 2008. Now, the credit default swap market was a new market. So credit default swaps, I don't have time to go really into it. They're basically insurance contracts that people bought and sold off of bonds and mortgage-backed securities. That's really what it was. Now, at this point, there was no exchange for these credit default swaps. And if you wanted to buy or sell a credit default swap, you literally had to get on the phone, or you had to call your broker at Morgan Stanley, and they had to get on the phone and call around and see if they could find another person that wanted to make a trade, and you just negotiated the price. You negotiated the price. And so that's how the credit default swap market was operating. People were just making calls, figuring out what someone would actually buy or sell it for, but there was no price discovery. And they thought, okay, we think we have a good idea of what these things are worth because, we've made a couple transactions. Next thing you know, the market goes crazy. The housing market crashes. And people start calling around and there's no buyers. No one's buying. 0 people are buying. So if you have an asset on your book, you have to do what's called mark to market. You have to mark to the market price. Here's the problem. No one knows what the market price is. Now, surely these aren't worthless. Some of them did turn out to be worthless. But how do you determine the value if there's no market, if there's no buyers? So that was a big problem, is that there was a real struggle in how do we now value these assets that we don't know what they're worth. We know they're not worth 0, but we have no idea because there is no counterparty out there. And it caused a big problem, and they had to write down those assets, and it caused a lot of banks to go into some serious trouble. It even brought Lehman Brothers down. So that's price discovery. That to me is the best example of how price discovery is really really important. If you don't know what the market is, it's tough. One of the things I don't love about real estate is price discovery is kind of difficult sometimes. Lately, with the hot real estate market, I'll talk to people and they'll be like, hey, the house is listed for $250,000. I'm going to go in at $240,000. I'm like, you'll never get it. You will never get it. You'll have to pay, again, if it's listed for $250,000, you'll probably have to pay $280,000. You're going to get in a bidding war because the market's so hot right now. And sure enough, that's where it sells for. So where's the price discovery? You don't really know. And then the same thing in 2009, if you had to sell your house, you didn't know what the value was. You didn't know where the buyers were. And frankly, there was no idea of where there was price discovery. One of the reasons I don't love real estate is for that reason. When it finally comes time to sell, price discovery is quite difficult. All right, we need liquidity. Liquidity. This is where, again, we need to have enough liquidity to where we can move in and out with ease. That's a big thing. Again, everyone understands liquidity, I think. And then last, guaranteed counterparty. A guaranteed counterparty. Now, this is where you know that there's somebody on the other side that will take your trade. Now, that's what the exchanges are there for. And the fact that futures trade on exchanges mean that we get all 3 of these. We get price discovery, we get liquidity, and we get a guaranteed counterparty. Now, futures trade on exchanges like the CME Group, the CBOT, Chicago Board of Trade, ICE is the Intercontinental Exchange, NYMEX. So just like the Dow, or just like the New York Stock Exchange and the NASDAQ, Different products trade on different exchanges. Some of them trade across multiple exchanges. Some of them just trade on one exchange. For example, crude oil trades on the New York Mercantile Exchange. That's where the crude oil contracts are traded. Same with the gold futures. CME handles a lot of the index futures. We'll get into those in just a second. So again, the ICE does a lot of commodities, and they do crude oil there as well. So because they're all traded on major exchanges, we know that we have, number one, price discovery. You can look and see where the bid and ask is right now. We have liquidity, and we have a guaranteed counterparty. In the exchanges, the market makers must provide a market. Again, that's the law. The market makers must provide a market. So if there's no one there buying, they must be buyers. They must be buyers, and you can see where they are by looking at the bid and the ask. So again, the futures market technically open 24 hours a day. That being said, every broker has some times where they shut down. Actually, you know what? Let me take that back. The exchanges will close contracts throughout the day based on what the contract is. If it's not a very heavily traded contract, it probably won't trade 24 hours a day. Some of the soft commodities may be closed for 6 or 7 hours out of the day. If it's a very heavily traded contract, it will be open for almost 24 hours a day. So again, these are for the index futures. You'll see that they'll close for 15 minutes at 4:15 Eastern Time, and they close for another 30 minutes at 5:30 Eastern Standard Time. So again, these are just the hours of the exchanges. Now your broker can always make a choice that they don't offer trading during certain periods of time. But this is where, again, Google comes in handy. You can see when it's actually able to be traded. So the great thing about futures, it fits all of our criteria. You can absolutely pretty much trade any futures contract that's hosted on a major exchange. All right, let's talk about the types of futures contracts. Now, futures trading got started with what's called the soft commodities. So if you ever hear that term, the soft commodities, we're really talking about agriculture, farming, cattle, frozen orange juice, pork bellies. These are the soft commodities. I'm really going to steer you away from the soft commodities. The big reason I say that is that there's a couple things that I don't like about them. Number one, there's not much liquidity. And they're actually very susceptible to real big news. For any of you who have seen the movie Trading Places, which is it's a great old movie. It's all about frozen orange juice. They're trading frozen orange juice futures contracts. And what happens is they fake a crop report, that the crop report was bad and that there's going to be no frozen orange juice, and it caused the market to plunge. And so you can get some really big moves in the soft commodities, and you can actually get what are called limits. When a futures contract is trading down limit, what that means is that it's hit its maximum amount that the exchanges will allow it to move that day. Now, for those of you that remember back into 2008, there were a few times that the Dow, the S&P, and the Nasdaq futures were down limit. What it meant was they were not going to allow them to drop anymore. They were down, I think it was 6% overnight. And what they did is they halted trading. You could not trade the futures contracts because it hit its limit. All right, now again, this is where we talk about liquidity. All of a sudden, you're now running into liquidity issues where you can't sell. Now, there are some horror stories where there have been some soft commodities that have been limit down for multiple days in a row. So it goes limit down for 6%. The next day, it opens limit down for another 6%. The next day, it opens limit down for another 6%. As you can see, you're locked out of the market the whole time it's limit down or limit up. Now, that happens so rarely, and frankly, that doesn't even happen much anymore. This is like back in the 1970s and 1980s when we didn't have the sophisticated trading environment we do, where we've got tons of computerized trading and people taking other sides of the market. It definitely happens less, but it is absolutely something you should at least know about and be concerned about. Again, the soft commodities, they don't have a lot of liquidity. They have wider bid-ask spreads. Again, I don't see any reason. Whenever I have a trader says, Rob, I really want to trade cotton, I'm like, why? What do you think you know about cotton? Like, it's a symbol. It's a market price, and it goes up or down based on supply and demand. Like, it doesn't matter if it's cotton. Why would you want to trade cotton, please? And usually I say, no, sorry. You can't. There's no reason to trade cotton. Again, bad liquidity, risk of limit up and down. There's no reason. There's so many symbols out there you can trade. Just trade something else. All right, let's talk about the hard commodities. This is where we're talking about metals and energy. So again, really mining products. We talk about gold, silver, copper, platinum, palladium. I mean, they've got a whole bunch of metals that I frankly haven't even heard of. You got the energy contracts, which are going to be oil, natural gas. Now, these are absolutely fine to trade. These are absolutely fine. They've got a lot of liquidity. Very, very rarely has there ever been limit up and down in any of these contracts. I mean, I can't even imagine a situation that could put these up to limit up or limit down. They've got a ton of liquidity. They're very, very heavily traded. So to me, the hard commodities are absolute candidates for trading. But where the real liquidity is in the financial futures contracts. Now, what they've done is they've gone ahead and created futures contracts just pretty much like they created ETFs. So before they created the spiders, the symbol SPY that basically follows the S&P 500, they've had the S&P futures around for years and years and years. And that's basically the same thing as the spiders. It's the S&P futures contract. Now, again, they have the large futures contracts, and then they have what are called the minis. Now, it's just exactly what I went through when we went through the gold futures contract. I believe there is a smaller gold futures contracts where the large gold futures contracts is 100 ounces. I think there's a smaller one that is like 10 ounces or 50 ounces. So it's just a smaller amount. Now, the E-minis is where all the liquidity is in futures. I shouldn't say all, but again, the majority. This is where, again, you could take a look at the Dow E-minis. The symbol is YM. You could take a look at the S&P E-minis. The symbol is ES. Or you could take a look at the NASDAQ. The symbol is NQ. Now, of course, if you say to yourself, oh, I'm not going to remember those symbols, again, Google. Google is your friend. Just look up what those symbols are. So the financial futures contracts are really where a lot of the big trading happens. So you see a lot of trading amongst those indexes. S&P, Dow, NASDAQ, Russell. Those futures are very, very liquid. Also, volatility product futures contracts. So again, we have volatility futures. And again, they've created all sorts of futures prices. Years ago, they created a home price futures. This follows, I believe, the Case-Shiller home price index. And you can actually now, for the first time, hedge out the exposure in your house. Look at that. Isn't that nice? You're worried about your house going down in value? You just run over to the CME and you buy some, or you sell some home price futures. Now, of course, that's a silly thing to do because, as you know, real estate is quite local. But you're basically making a bet on the national home price index. But again, that's the cool thing is they've created these futures products as a way for people to buy hedges. Now, again, if you're a very large mortgage lender, this might be something that you really enjoy to basically hedge your exposure in your portfolio with some home price futures. So again, I'm going to say this: financial futures contracts, they're great. They have plenty of liquidity. They're perfectly great to trade. The hard commodities also, again, they've got tight spreads. There's lots of liquidity. The soft commodities, just ignore them. You don't need to trade pork bellies. There's no reason. There's absolutely zero reason for anybody who is a trader to trade pork bellies. It doesn't make any sense to me. It doesn't. And I know every now and then I'm going to have one of our traders say, hey, what, can I trade this? And I'm going to be like, no. What's the point? You don't know pork bellies. Like, if you know pork bellies, go know Apple. Go know, Netflix. You can know it just as good as pork bellies. Okay. Enough of my ranting and raving. All right, let's talk about contango. Now, contango it's a pretty interesting thing to talk about. And the way contango works is basically when you look at a futures contract, you have your spot price. Now, the spot price is today's price. Now, if you ever hear the terms the spot gold market, understand that is not the futures market. Spot gold is, I want to buy gold now. I want to buy gold right now. I want to buy the physical gold right now. Well, that is the spot market. So whenever you hear spot, that means it's not a futures contract, it's the price today. So the way the future market works is it works through what's called backwardation. Backwardation is basically kind of like time decay of an option. You've got the 1 month, 6 month, 1 year. So again, everything's going to cost a little bit more because, as you're further and further out, there's a little bit more risk. There's a little bit more chance of the price changing. This is called backwardation. And it's always a curve like this. All right. Contango is when that all gets messed up. Now, contango is very, very dangerous for anyone who's trying to get, I'll use the word, tricky with the futures markets, or they're trying to play around. I know that this has really killed a lot of volatility traders back in 2015 and 16 when all the volatility products got really bad. Contango, it's when everything goes crazy. Typically, you have 1 month, 6 months out, 1 year out. It's very normal. You can get contango that may look like this, where that 1 month contract goes crazy. So let's say that there is a hurricane bearing down in the major oil producing place, and that hurricane is going to hit in a couple weeks. All of a sudden, this contract is going to go crazy because this is where the risk is. They know that after the hurricane is through, they're going to rebuild, they're going to get production back online. They know the price is going to go down, but everything for that month is going to go crazy. Now, what happens is this causes contango. And a lot of people, they'll basically do spread trading on futures, where they'll buy a 1 month out, sell a 6 month out, and they'll try to get this little bit of profit in here. And again, it's usually a pretty good trade. But when contango hits, all of a sudden you get this really strange movement. And I really caution a lot of our traders that have sent in some trading strategies, and they've mostly dealt with volatility products. The volatility products, like if you're trading the VXX is the ETF for the futures on volatility. Those can get in contango. And so if you're trading one volatility product against the other, you may get an adverse move where the VXX goes one way and your other one also goes the same way or the other way. And again, you're going to have this loss that you did not expect. Remember, you're trying to catch pennies here. You're trying to catch pennies in this little trade where you're trying to buy one, short the other. And all of a sudden, they get so far apart, you're losing thousands, tens of thousands, hundreds of thousands of dollars. So whenever you hear the term contango, that's really talking about over the curve of time, where it should be this kind of linear thing. Anytime something happens, it can screw that up. Now, of course, if you're just trading one contract, it's not that big of a deal. There's not as much risk. When you're trading two contracts, that's when it becomes a big deal. But I wanted to go through contango. You're going to hear that term if you spend any time in the futures market, and you're going to hear, again, on TV say, hey, it's in contango. It just means that the normal curve is no longer in existence. All right, so that is basically futures in a nutshell. Now, hopefully, again, I at least pointed you in the direction to go. If you want more information, you say, hey, you know what, I really want to trade the E-minis, or I really want to trade the silver futures. You know where you need to go get some information, go get the underlying symbol, go find out how much it controls, and then find out the margin on each symbol. Let's move into something that you know well, futures options. All right, so the futures options market, it's a very big market, and this is something you already know. So we're basically looking to buy options on these futures contracts. So instead of buying the December $1,200 futures or December gold futures, we can buy one contract of the December 1,200 calls on the gold contract. So again, you're still controlling $120,000 worth of underlying gold, but by buying one contract, the market price, I checked that a little bit ago, is around 23 bucks. So basically, you're controlling $120,000 with $230. Now, I like that much better. I like that much better, much less risk. I can actually really control everything. I don't have to worry about contango. I don't have to worry about limit down. I actually have control of everything by using the futures options. So again, like I said, everything that you've learned over your life about options is 100% applicable to futures options. Again, you can do a butterfly on these contracts. You can do a diagonal call spread. Really, you can do anything. In the end, again, it's a symbol, and the options are there, and the options are actually quite liquid, especially if you are in the index futures. All right, let me bring this up to, we don't have a ton of traders doing this, but I know I've got a ton of people out there that are doing strategies like this. A very popular strategy lately is, as we've had these bullish markets, we've had low volatility, we've had no big freakouts for the last couple of years. We've had one 10% move down. We had that in January of 2018, and it was barely 10% down. And before that, it wasn't until 2016 they made a 10% move down. So it's been a very quiet market. So what happens is some strategies start to become very popular. And one of the strategies that I've seen become very popular is either being short volatility or by doing out-of-the-money condors or selling naked puts 10% under the market. So again, these are all the things that people love to do because, volatility's low. Volatility's low, and they love to do condors and butterflies on the spiders, and they like to do it. If that's what you're going to do, first off, I hope you have something up your sleeve for when volatility hits, because again, everyone's doing these strategies, and what they're doing is they're making a few percent. They're making like 1%, a half a percent, and it's going to be right a large percentage of the time. They're probably going to be right 95% of the time. But then when it does blow up, they're going to lose 95%. They're going to make a couple pennies when they're right, 20 cents, 30 cents. But when they're wrong, they're going to lose $9.70 on the ones they're wrong on. Now, everyone has these adjustment strategies, and I wish you could see my very sarcastic air quotes that I'm making right now. Adjustment strategies. And they say, Rob, if it starts to go against me, I'll just make an adjustment. I'll adjust it. I'll move one of the legs down, or I'll move one of the legs up. And I see them, and I look at them, and they are in the spiders and the Qs. Okay, that's really dumb because the spiders and the Qs are literally the same thing as the S&P futures contracts and the NASDAQ futures contracts. Here's the difference. The spider and the Q options, they're open 15 minutes before and after the bell. So they're open roughly 8 hours a day. If you were doing these strategies on the futures options, your futures options are almost open all day long and all night. That means if you do need to make an adjustment, that you can because the market's open. If you were doing any strategy like this, selling puts under the market, wide condors on the market, you better be doing it in the futures options because it's actually quite silly and dumb to do it in the ETFs. It just shows that you don't know exactly what you're doing, the fact that you're doing it on these contracts. So again, take a look at any strategies you are doing. And I always say, look, if you need the ability to move in and out of something, then you have to be in the futures options. You have to be. If you're going to open up a trade and leave it till expiration, be in the ETFs, be in the spiders, be in the Qs. That's perfectly fine. But if you are going to make any sort of adjustments, take a look at everything you're doing, and you better be in the futures. Now, they've even made futures contracts on individual stocks. They have futures on Apple. They have what's called single stock futures. Take a look at those. It's the same thing. It's a symbol. It's a market price, up and down based on supply and demand. All right, let's cover one last thing about futures, and then we'll wrap this up. Hedging. So this is the reason why futures were created, as a way to hedge. I know this isn't necessarily trading, but this is for people that are, if you're managing some other money, if you're, you do have some long-term investments, you can always use futures to hedge things out. So let's say that you have a large portfolio of S&P-like stocks, and all of a sudden you become concerned about the S&P potentially crashing. Now, right now, one S&P futures contract, and this is the E-mini, the ES, is worth about $150,000. If you had a $150,000 portfolio of mostly S&P-like stocks, you could simply sell one contract of the ES and basically hedge yourself out. It's a very cool way, and this is what all the pros do, and all the big money managers, this is what they use to hedge their portfolio. They find the most correlated futures contract, and then they buy or sell that to hedge out the risk. So again, calculate the amount of capital you want to hedge, find out what the futures contract is, and then you simply sell the one contract or buy one contract. Again, if let's say you're a big real estate investor and you've got hundreds of millions of dollars in real estate investments, you're probably a real estate investment trust at that point, but you're worried about home prices, sell that HPI, that home price index contract. Hedge out some of your risk. So obviously this isn't something we do in trading. The best thing to do if you have a trade that's going against you or you're worried about the trade, sell it. Just get out of it. Just get out of it. Go to cash. That's trading. But in other styles, in other parts of your life, you really want to take a look at futures as a way to hedge things out. All right, well, let's wrap this up here. All right, so futures are basically a leveraged way to take direction in the market. So just a plain old buy or sell the futures contract. It is a directional trade, meaning it has to move the way you want it to move in order to make a profit. And it's leveraged. It's highly leveraged. So again, we talked about somewhere between 20 and 40 to 1 is going to be the leverage. So this is where you must be very, very careful. People say, oh, I've got $10,000. I can buy 3 futures contracts. Well, 3 futures contracts is basically equal to about $500,000, $500,000, and you've got $10,000 in your account, and you get a 1% move against you, and you just wiped out half of your account. It's very risky if you don't have proper position sizing and if you don't have enough capital. So the way it works at Maverick is that futures options, look, you guys already have the green light. If you're approved for capital sharing, then you already have the green light that you can absolutely trade futures options. We do not like anything on the soft commodities, so just stick with the most liquid. If you do want to trade futures and you want to trade, again, futures are always a directional trade. So, hey, I want to make a leveraged directional bet. We do allow that at level 3. So again, you're going to have enough buying power to where, that's not a big deal. You're going to properly position size, and we require an updated trading plan. So again, if anyone is up at that point, you want to add futures trading, just go ahead and let us know, and we'll ask you for an updated trading plan, and we'll get you going. But let me already tell you what we're likely going to say. Oh, if you want to make a leveraged directional bet, why don't you look at Forex? Why don't you go look at our Maverick Forex division? That is by far the best way to make a leveraged directional bet. By far. There's no question about it. If you are looking to day trade, if anyone wants to day trade, you shouldn't be in stocks, you shouldn't be in futures, you should be in Forex. It is the best. I absolutely love trading Forex. So I would, if you call up and say, hey, I want to add futures on, I'm going to give you a hard sell on trading Forex instead of futures. It's, to me, there's no comparison whatsoever. All right, well, that wraps up our futures trading. If you guys have any questions at all, please let me know. You should know my email address by now, Robb, R-O-B-B, @maverickTrading.com. See you later, everyone. Thanks for joining me. Goodbye.